Hello, CA Foundation champs. Hope you all are doing amazing. So, as we were revising unit wise partnership accounts, we have reached at the last unit dissolution of partnership firm and LLPs. From the exam point of view, definitely a very good unit which has a potential to appear for a good number of marks. So let's give our best in revising this in a wonderful way. I have jotted down in a most simplest manner with respect to understanding the concepts. So after we learn the concepts, let's apply the same in order to solve the questions so that you gain maximum confidence. So let's begin, guys. Dissolution of a partnership firm and LLP. As we are doing in every unit, why would this arrive or what would be the reason for facing this situation? So, circumstances leading to dissolution of partnership. A partnership is dissolved or it can come to an end due to following reasons. The expiry of the term for which it was formed. If you remember in unit 1, there was a point while we were discussing about the basics of partnership. So some partnership firm can also include duration of their business if they just want to operate for a particular purpose, or it could be seasonal. So based on the same note, if the expiry of the term for which it was formed comes to an end, so then there will be dissolution. Then completion of the venture for which it was entered into, that is the purpose for which it was formed, does be completed. There is the death of a partner and insolvency of a partner. So these appears in a case where there are only just two partners and either one of the partner is expired or one of the partner faces insolvency. Partnership firm cannot be run only by an individual, so at that point of time there could be dissolution. So with respect to this dissolution, what could be the consequences which would arise that would impact partnership books? On the dissolution of a partnership, firstly, the assets of the firm, including goodwill, are realized. So before we understand this stepwise, in simple words, if I have to explain what happens in dissolution, it is just nothing but closing down of the business. Now just imagine the partnership firm is getting closed. With respect to this closure, what are the consequences? What happens with respect to books of accounts? That is what we are going to understand stepwise. So on dissolution, what the firm does is, what all the assets belonging to the firm will first be realized. That means it will be first sold. So after we sell the assets, we receive some consideration due to sale of assets. Then the amount realized, that is whatever we get from sale of assets, is applied towards what? Repayment of liabilities. Now this liabilities, they are addressing about outsiders liabilities. Example could be your creditors, some loan taken from an outsider, even spouse partner, that is partner's spouse loan is also considered as an outside liability, and loan taken from partners. This is with respect to there is order of payment which is available. We will understand that. Afterwards, the capital contributed by partners is repaid, and if there is still a surplus, it is distributed among the partners in their profit sharing ratio. This is nothing but the structure how you should go ahead with dissolution. So more discussions on this we will definitely observe. So this is just giving you an overview. Yes. After payment of liabilities of the firm and repayment of loan from partners, that is from the amount what we have received from sale of assets, we will first repay the liabilities, settle partners loan, and then if anything left, capital. After repaying everything, we will distribute it to partners in their profit sharing ratio. This was the structure. If the assets of the firm are left over, are insufficient to repay in full the capital, the deficiency is borne by the partners in their profit sharing ratio. So deficiency here means the amount available with respect to the assets realized is falling short with respect to the dues which are to be settled by the firm. So if this is the case, if the other partners have some excess balance, the situation here of deficiency would be dealt in by them in their profit sharing ratio. So this particular para is just giving you an overview points, guys. Further, according to the provisions contained in the Partnership Act, upon dissolution of the partnership, this is whatever we are going to discuss is as per the provisions contained in the Partnership Act. The mutual rights of the partners, unless otherwise agreed upon, are settled in the following manner. See, if there is no structure provided, when there is a situation of dissolution, the provisions of Partnership Act prescribes this order. Losses, including deficiencies of capital, are paid first out of profits and then next out of capital. And lastly, if necessary, by the partners individually in the proportion in which they are entitled to share profits. This is treatment of deficiencies. The first preference is we will try to settle with the profits if available. Then the next preference would be the capital balances. Further, in the proportion in which they are sharing their profits or losses. The assets of the firm, including any sums contributed by the partners to make up deficiencies, have to be applied in the following manner and order. So, this is what is important. So, there is an order of priority with respect to the payments to be made. First, in paying the debts of the firm to third parties, that is nothing but settlement of outside liabilities. Then, in paying to each partner rateably, which is due to him from the firm in respect of advances as distinct from capital. So, this is basically talking about partners' loan. So, if there are three partners, this point, what it talks about rateability here is if all three are giving you the loan, you have to first observe the priority in which it has to be repaid depending upon the terms on which it is being considered. In paying to each partner what is due to him on account of capital. See, imagine we are understanding this from firm's point of view. So when there is partner's capital which is being displayed in the partnership books, it is nothing but an obligation for the firm to repay to the partner. So this is point is what is talking about with respect to due on capital balances. The residue, that means balance, if any, to be divided among the partners in proportion of which they are entitled to share profits. The same thing which we are going to learn step by step. You will get a proper clarity on order of payments and several other points which was completely touched here. So first, step by step, we will understand what is the first step in dissolution. Application of assets. Application of assets means whatever amount is realized, we should use this for what purpose and in what order. See, when a firm is dissolved, the assets are disposed of and the proceeds, that means whatever money we receive, are applied in the following order of priority. This is very important. So, there is a priority prescribed. This is the order which we need to follow. So, first point is towards dissolution expenses. See, dissolution is nothing but as easy as closing down. So, this is not a simple procedure to just get it over for one day or 1 week. It definitely involves lot of people's efforts to understand the value of assets, whether it is being sold for profit or loss, and certain other rearrangements with respect to payment of liabilities, etc. So, in order to complete this process, the firm definitely has to incur additional costs, which would be addressed as dissolution expenses. So, whenever we realize any amount from the assets, the first payment will go towards dissolution expenses. That is cost incurred to carry out the dissolution process. Second preference will be towards outside liability. So, outside liability includes your creditors, bank loans, and any other outstanding expenses. Next priority will be towards partners' loan. So, repayment of loans which is given by partners to the firm. So, that will be the third priority. Next comes partners' capital. So, that is whatever capital balances which is due, which has to be repaid by the firm, that will be settled. Last, residual balance means nothing but anything excess remaining in the firm in with respect to the amounts realized from sale of assets. Surplus is divided among partners in their profit sharing ratio. I hope you got a structure of what could be the order of payment. Next, closing the partnership books. What do we exactly do with respect to dissolution? First is nothing but we understood application of sale of assets money. Now, to close the books, every asset, liability, and capital appearing in the balance sheet must be cleared. So, the first and foremost step is if you have to understand the business of the firm, if we observe the balance sheet, we will get a proper clarity. So, first step to close down would be to clear the balance sheet. So, in balance sheet, what do we observe? We have assets, liabilities, and capital balances. So, these needs to be closed using a separate account called as realization account. So the activity what we are doing is nothing but realizing the money derived from the assets to pay off the liabilities. So there is a realization account. So first point under this would be closing assets. See, understand one thing, the business is getting closed. So whatever balances were present in the partnership firm till now is nowhere going to be relevant in the future because there is no business being run. So therefore, first aspect which we have considered is with respect to assets. So how do we close the assets? In this case, whatever we consider with respect to the normal assets, the same treatments applies for goodwill also. Goodwill definitely had a separate impact, separate treatment in other units. But when it comes to dissolution, it will be treated at par with normal assets. Be very clear with this point. So all assets, including goodwill, are transferred to the debit side of the realization account at their book value. Book value is nothing but what value is represented in the balance sheet. So understand one thing. Assets by default will have a debit balance. Now I have to close the assets. So if I have to eliminate this, what will I do? I will credit it. So I will transfer it on the credit side. So if I close the asset, using which account do I do it? So for this, we have a separate account called as realization account. So therefore, the entry will be realization account debit to assets. What all list of assets we have, everything will be transferred to realization account. There are few exceptions. Fictitious assets like debit balance of P&L or some suspense account, there is a separate treatment for this because this appears on asset side. I'm just mentioning this point here. Further, there is one important aspect with respect to provision. Now, if you have observed balance sheet, provisions will be displayed on the asset side itself. Like there would be sundry debtors or trade receivables. There would have been less provisions for whatever purpose it is created, and the net balance will be shown on the asset side. So, what does this point tell us? If an asset like debtors has a provision for doubtful debts, the gross value of debtors is transferred to the debit of realization and the provision is transferred separately to the credit side. Because why? Here we analyze this as assets and liabilities and not as a net of item. So what does this point prescribe here is, if there is such values presented, we will take gross value, that is of debtors, as assets and provision as liabilities. With respect to this, the treatment will be realization account debit to debtors because we are closing the debtors. For provision account debit to realization because that is taken as a liability. Example here, if debtors are 50 and provision is 2000, transfer 50 to the debit and 2000 to the credit of the realization. That's what we understood with the journal entry. Next, treatment of fictitious asset. Remember, I just mentioned the point right away. So items like a debit balance in profit and loss or advertisement suspense are not transferred to realization because ultimately what does fictitious asset means? It is a temporary natured asset. It is used for the purpose of writing off in the future. Now, since it is a partnership firm, we will write off using partners' capital balances. So therefore, it will not be transferred to realization. So realization is nothing but those which help us generate money and to settle the liabilities. So in this case, there is nothing happening with respect to fictitious assets. So therefore, it will not be transferred to realization. They are written off directly to the partner's capital. So when there is such fictitious asset present, the entry what we observe is we will directly route it through partner's capital account. So therefore, partner's capital account debit to fictitious asset. The logic of framing this entry is fictitious asset will have a debit balance. I have to cancel it, so I will credit. This will bring down the capital balances. Partner's capital will have a credit balance. So I have to bring down the balance means it will be debited. I hope this is clear. Next, closing of liabilities. So now what happened? We recorded the assets. We are still not realizing it. The next step would be to realize we are first just clearing the balance sheet. So first step was we just closed all the assets. Now moving to closing liabilities. Only outside liabilities. This is very important. Only outside liabilities. This includes creditors, even spouses loan, that is partners spouses loan is also treated as outside liability, are transferred to the credit side of realization. See, liabilities by default will have a credit balance. If I have to eliminate this, I will have to debit. So I will debit the liabilities with respect to what account? Realization account. So therefore the entry will be outside liabilities account debit to realization. One important point here is A partner's loan is not treated as an outside liability. See, the name itself says it is an outside liability. A partner loan, that is, whatever loan amount advanced by a partner will not be treated as an outside liability. There is a separate treatment for that, we will understand. Next, so in the balance sheet, we have addressed assets, liabilities, outside liabilities. Then there will be one more point, which is reserves. Reserves is same treatment whatever we have done till now. See, these are transferred directly to the partner's capital in their profit sharing ratio. Be it retirement or death, where we would have observed about reserves. When the new partner is leaving the firm, or when the new partner is admitted, or there are any other reconstitution, whatever reserve balance is already available, they make sure that the partners take away all of them, and then a fresh reserve will be maintained after the reconstitution. So here, since the business is getting closed, we will take the same treatment for reserves. Next, capital or loan account. In the balance sheet, the remaining is nothing but capital account and loan account of if there is partner's loan. So partners capital and partners loan are not transferred to realization. That means there is a separate treatment for that. Now we just understood what goes to realization. Just to summarize, we will take away all the assets. Fictitious asset is there, it will go to partners capital. Then we will close all the liabilities, only outside liabilities. Reserves will go to balance sheet, partners capital balances, partners loan will not appear in realization account. I hope this is clear. Now, what we did was we just first cleared the balance sheet. The next step is we have to sell the assets, realize money, which will be used to pay off the outside liabilities. So, realization of assets and settlement of liabilities. Sale or takeover of assets. This is the activity of sale. If the asset is sold for cash, what is the normal entry we were passing when the asset is sold? We will receive money, so bank or cash account debit to asset account, correct? Now, I was crediting asset because it was going out of the business. Now, understand one thing. I have transferred the asset to a separate account called realization. Now, the asset is represented in a realization account. So, the entry for this will be bank or cash account debit to realization account. I hope you are understanding the structure. So, this is the case when it is sold for cash. Sometimes some partners who will have some outstanding balances which the firm has to pay, the partner will instantly take off the assets. So if the partner take over the assets, the entry for this will be, understand the logic behind this. Partner's capital credit means the firm has to pay. Now, the partner is taking off the assets for some balance. So, therefore, his balance has to come down. So, therefore, partner's capital account debit 2. Where is the asset sitting? It is sitting in realization. So, I will represent realization. So, 2 realization account. I hope you understood the structure. So, this depends on what information is available to us in the question. If it is sold for cash, cash or bank. If the partner takes it, partner's capital account will be debit. Yes. Next, payment of expenses. Now, there would be expenses, majority would be dissolution expenses. This again need to be treated or addressed clearly because remember the order of payment. If it is paid by the firm, the entry for this will be realization account debit to bank. What is the logic behind this? If I've paid any expenses, what is the journal entry? We understand expenses account debit to cash or bank when it is paid. Now here I will not create any new account. The business is getting closed. Everything will be represented using one different account called realization account. So therefore realization account debit to cash or bank will be the entry. Sometimes the partners take the initiative that I will pay the expense. So if it is paid by a partner on behalf of the firm, in this case, understand the entry first. Normally, expense should be debited. I cannot open the expense account, so I will route it through realization. So realization account debited. 2. Partners capital account. What is the logic behind to credit partners capital? See, what happens here is this is actually partnership firm's expense. So if the partner is taking the responsibility that I will bear this expense, the partner makes sure that he will take the reimbursement later. So when partner takes the reimbursement, his balance will increase. That means it has to be credited. So therefore, the journal entry here will be realization account debit to partner's capital account. I hope this is clear. Next, Payment of liabilities. So first you understood if it is used for paying expenses. Next, if it is used for paying liabilities. If it is paid in cash, what liabilities transferred where? Liabilities transferred to realization. Remember? So now liabilities is represented with realization. Realization account debit to bank account. Simple logic. If the liability is paid, generally what we were doing, we were debiting because the balance would come down. Liabilities account debit to cash or bank. Liabilities is sitting in realization. So the entry is realization account debit to cash or bank. If it is settled by a partner, again, same like what expenses they did. If it is settled by partner today, partner makes sure that he will take the reimbursement. So liability is represented in realization. So realization account debit to partner's capital account. I hope both of this with logics you understood why we are crediting partner's capital. Moving further. Assumptions. Some assumptions what we have to observe if the question doesn't speak up anything. Liability payment. If the problem is silent about the payment of liability, sometimes we will transfer all of the liabilities, but there could not be any information available with respect to its payment. If that is the situation, assume it is paid at book value. We will go with an assumption that it is paid at book value. Further, just a minute. See, assume it is paid at book value. Asset realization. That is, if there is no information prescribed about whether the asset is sold or not, what should we do? If the problem is silent about the realization of assets, assume it is not sold. That means it is not realized because you cannot imagine that it will be sold at book value as it is. Clear? These are the points which we definitely have to take care, considering one by one if the problem is not specifying the treatment of respective items. So here we till now we understood what should be the structure of approaching a dissolution question. Now this is just a specimen or a format of a realization account. This is nothing but a ledger format, debit and credit. On the debit side, you will see all sundry assets, that is list of various assets, because the entry while we clear the balance sheet would be realization account debit to assets. Understand one thing, this will exclude cash or bank, because for cash or bank we will prepare a separate account since this is representing for inflow or outflow of money. So therefore it will not be considered as a part of realization. Debit balance of P&L because this is a fictitious asset, and partner's current account if it has a debit balance, capital if it has a debit balance, and loan accounts. Excluding all of these, we will transfer all sundry assets. Then likewise by sundry liabilities, that is clearing the balance sheet liability side, excluding credit balance of P&L because this is transferred to partner's capital, partner's current account, capital and loan account. If you remember one thing, there was one note which we had learned as we were discussing the pointers. Partners' capital and loan accounts will not be transferred to realization. So you can also include partners' current account of the same manner. Later, the next step would be selling off assets. So when we sell the asset is getting us money. So bank or cash will be debited to realization. So there will be by bank or cash amount realized from assets and unrecorded assets. Meanwhile, there would be one point, if there is provision, gross would be recorded as debtors and provision will be shown with respect to liability. So therefore, it is coming on the credit side. Next, if you're using this money for paying dissolution expense, realization account debit to cash or bank, that is what is mentioned here. Further, if you're using this to pay off the liabilities, it will be bank or cash amount paid for liabilities and unrecorded liabilities. There could be some unrecorded liabilities, unrecorded assets as well. See, for you, it doesn't matter at all because we are closing the books of partnership firm. If it is not recorded, it doesn't matter now because it does not have any relevance. We are only concerned about the cash inflow or outflow with respect to this unrecorded items. Further, after doing all of this with respect to assets and liabilities, we will either have profit on realization or loss on realization. Also, one more thing, there could be some transactions wherein the assets are taken over by partner. So that is also impacted in realization because ultimately asset is sitting in realization. So if that is the case, by partners capital account. If the liability is paid by partners, so two partners capital account. So after considering all of this, when there is more of credit balance than debit balance, there will be profit on realization. If it is a reverse, there will be loss on realization. This will ultimately be transferred to partners capital in their profit sharing ratio. Loss on realization in profit sharing ratio. I hope you understood the format and how the items will be reflected in realization account. Moving further, after understanding realization, there are some other points which needs to be taken care. Let's understand that. Special cases in settlement. So in settlement means you have the amount realized from sale of assets in the time of paying the liabilities. Exchange of asset for liability. If a liability is settled in full by an asset, that is complete value of liability is taken care by asset, no entry is required for the exchange. Why? Because understand one thing, there is one liability, there is one asset. So if there are just netted off, there will be no impact because one side there will be decrease in assets, also there is decrease in liabilities. So the impact would be same. So therefore there will be no entry. Example, a creditor of 5,000 accepts office equipment. Book value of this is 4,500. If you match the monetary kind, it will definitely not have the same relevance. But the creditor is okay to accept 4,500 with respect to 5,000. So in full settlement, for this there is no entry. Next case, if a creditor accepts an asset and the balance is paid in cash, that is, he accepts an asset and the shortfall of the difference of his due is paid in cash. Only the cash payment will be recorded because the ultimate impact will have no effect on the books of accounts. Example, a creditor for 5,000 takes furniture worth 3 and the remaining 2,000 is paid in cash. See, when something is going out of the business, it will definitely have an impact. So only this outflow will be recorded. Only the 2,000 payment is recorded. How will we record this? Realization account debit to cash account. Because this is with respect to settlement of liability and you are paying off. So therefore, realization account debit to cash or bank. Unrecorded assets or liabilities. As I mentioned earlier, there will be no problem with respect to recording it first. We are only concerned about whether there is sale or payment of unrecorded assets and liabilities. The treatment is same as recorded items. Proceeds from, that is sale, of unrecorded assets are credited to realization and payments for unrecorded are debited to realization. The question can sometimes confuse you with respect to unrecorded impact. In dissolution only, this doesn't matter. Be alert with this point, guys. So next, settlement of partner's loan. Now, with respect to partner's loan, if it is present in the liability side, this is not an outside liability. So how to realize this? The treatment depends on the partner's capital balance. So this is correlated with partner's capital balance. If the partner has a credit capital balance, so understand one thing, partner's loan, that is a firm's liability. Partner's loan will also have a credit balance. Partner's capital will also have a credit balance. That means both should be paid by the firm. The loan is paid off in cash. So this is what we consider. So if it is paid, partner's loan account debit to bank will be the entry because ultimately capital also has a credit balance. But due to order of settlement, if you remember, first will be with respect to dissolution expenses, second will be towards outside liability, third will be with respect to partner's loan. So partner's capital comes later. So when we are settling partner's loan, the entry will be partner's loan account debit to bank account. Next, if the partner has a debit capital balance, this is very important to understand. Partner has a debit capital balance. What does that mean? If it is appearing on the asset side in the balance sheet, understand this from firm's point of view. If the partner's capital is showing debit balance means for firm it is receivable, that is partner has to pay. So there is one side receivable for the firm. Partner's loan is a liability to the firm. So on the other side there is a credit payable to the firm. So in this case, how to settle partner's loan? The loan is first used to set off the debit balance in the capital account. The loan is first used. That means, see, one side for partnership firm is receivable, on the other side it is payable. So what do they tell here is, let's understand this with an example. Assume partner's capital is having balance of 50,000, and then there is partner's loan worth 20,000. So this is having a credit balance and this is having a debit balance. So what they are telling here is, since 50,000 is receivable for the firm, we will just first use loan towards this receivable. Anyway, the firm had to pay 20. So since it is connected to one particular partner, we will use this to net off. So the loan is first used to set off the debit balance in the capital account. So in this case, partner's loan will have credit balance. If I have to use this towards capital, what will be the entry? Partner's loan account debit. So this will cancel his account. Partner's loan account debit. Partner's capital had a debit balance. So if I have to bring down the balance, I will credit to partner's capital. So this will be the treatment if partner's capital has a debit balance. This is very important when it comes to partner's loan. You will understand this in more detail while we take up the question. Is this fine? Yes. Next point. This is a very important point which definitely has a good potential if they have to frame a very good question from dissolution, guys. So let's understand this in detail because the concepts are very easy if you understand the steps. Insolvency occurs when a partner's capital account shows a debit balance and they are unable to bring in the necessary cash to clear it. See, insolvency is a position, it is a confirmed situation. Only if the partner has a debit balance, it doesn't mean he's insolvent. There should be a debit balance plus whatever is due from him, he's unable to settle it. That is, he's unable to bring in the necessary cash. Then the situation is confirmed as insolvency. There is partnership firm facing loss. So this is nothing but deficiency or insolvency loss. It is nothing but a firm's loss because it ultimately impacts partnership firm. Since partnership have unlimited liability, because understand one point here, there is no concept of separate legal entity between partners and the firm. So definitely it will have a direct impact on firm. So this loss has to be borne by solvent partners because those partners have credit balance in their capital account. That means they are in a favorable position. Partner who has a debit balance in the capital account will be called as insolvent partner. Solvent partners are those who has a credit balance. So how to consider this? Observe this example. There are four partners P, Q, R and S. There is a credit balance of P, credit balance of Q, debit balance of R and debit balance of S. These are their capital balances 1 lakh, 80, 20 and 50. So in this case, S is confirmed that he is insolvent. So in this case, 50,000 is his part of capital, which definitely has an impact of deficiency on the firm. This will be borne by solvent partners. Who are solvent partners? Solvent partners are those who have a credit capital balance. So this will be borne only between P and Q. Why? Because P has a credit balance and Q has a credit balance. R has a debit balance. So therefore, we will not disturb R in this process. Now this distribution will happen in what ratio? You need not worry about this. I have just taken some imaginary example to explain. So here it doesn't have any impact. So this will be done in what ratio? If it is mentioned in the partnership deed, that is what to be shared of insolvency, if it is mentioned in the partnership deed, we will go as per the partnership deed. If nothing is mentioned in the partnership deed, we will follow the steps as per a famous judgment which passed in, so that is understood as Garner versus Murray rule. So if there is insolvency, we will have to first understand that the deficiency resulting from insolvency of a partner will be borne by the solvent partners. So how is it done? The points are understood as per Garner versus Murray's rule. So what does this rule prescribe? So if you have to observe the importance of this rule, if they are going to definitely test on insolvency, you will see the majority of the questions framed on Garner versus Murray rule. Because if it is given in the partnership deed, then there would be no point for us to consider this aspect. Yes, the Garner versus Murray rule. What does this specify? If the partnership deed is silent, the following steps will apply. That is nothing but Garner versus Murray's rule. Two steps in this. First, solvent partners must bring in additional cash equal to their share or loss of realization. Understand one thing, while we discussed realization account, there was a situation where could there be profit and there could also be loss. So if there is insolvency of a partner in the partnership firm, majority case you will get, not majority, most times you will get realization loss itself. So the first step in application of Garner versus Murray will be solvent partners, that is whose balances will have a credit, must bring in additional cash. How much should they bring? They will bring additional cash equal to their loss on realization. So the entry when solvent partners bring in additional cash is nothing but introducing capital entry. So bank account debit to solvent partners capital. So this is what the entry we observe. This is the first step. Second one, deficiency distribution. Now we understood there is insolvency. Because of insolvency, his capital balance would be deficient. To resolve this only, the solvent partners have brought in additional capital. The second step would be how do we allocate or how do we distribute this deficiency? The final deficiency, how do we arrive at deficiency? You will take total of debit side of capital account minus total of credit side of capital account. Whatever value you get is nothing but deficiency amount. The question can sometimes give, we are able to realize some amount from his particular estate. So we will subtract that, balance is nothing but loss. So that is termed as deficiency. So this final deficiency of the insolvent partners is borne by the solvent partners. That is, how would they distribute? They will distribute in the capital ratio. Now, what does this capital ratio mean? If the method of maintaining capital is as per fixed basis, that is fixed capital method, then we will use the ratio of the fixed capital amount because it will definitely have no changes in the capital balance. If the question doesn't specify anything about it, by default, we will go with fluctuating capital method. How to take capital ratio if it is as per fluctuating capital method? Use the ratio of capital as they stood before dissolution adjustments, but after adjusting for reserves, accumulated profits or losses, and drawings. See, these 3 points are nothing but resulting due to dissolution. They were already there. If it was not dissolution also, we were normally doing this treatment. So therefore, you will take the capital balances before any dissolution adjustment. So what is dissolution adjustments? Anything happens with realization, that is any partners taking off the assets or paying with respect to liabilities, paying realization expenses, all these are nothing but dissolution adjustments. So before all of these, whatever balances will be available, we will consider the ratio in that basis. So what did we understand here? First of all, there is insolvency of a partner. So in this case, this insolvency, the deficiency created due to insolvency should have to be borne by the solvent partners. Solvent partners means those partners who have a credit capital balance. How will this be done? If something is mentioned in the partnership deed, we will go as per the partnership deed. If nothing specified, we have to apply Garner versus Murray rule. Garner versus Murray rule, two steps. First step, solvent partners will bring additional capital. How much? Equal to realization loss. Whatever there is share of realization loss distributed, they will bring so much as additional capital. For this, the entry will be bank account debit to solvent partners capital account. Second step, we have to distribute this deficiency. How do we get deficiency? Total of debit side of insolvent partner minus total of credit side. If there is any thing realized from his estate, we will subtract that. Now, this should be apportioned between solvent partners in capital ratio. Capital ratio we will determine using the method of maintaining capital. If it is fixed capital method, we will take the fixed capital balances. If it is fluctuating, we will take the capital balances before impacting any dissolution adjustments. This was the summary of insolvency and application of Garner versus Murray's rule. The next point is piecemeal payments. Now, what is this piecemeal payments? With respect to what all points we discussed, we will definitely take up questions, guys. I will also integrate more there while we solve the questions. First, we will finish off the concepts. This is the last concept in understanding your dissolution. Piecemeal payments. Now, what does this piecemeal payment means? Logically think, till now whatever we discussed was we will clear the balance sheet, sell off the assets and pay off the liabilities. But practically think, do you wonder that every asset present in the balance sheet will be sold at one shot? Definitely not. It will definitely take some time. So here what they say is, when you sell the assets, the realization will not happen in one particular transaction. It might take installments with respect to number of assets present in the business also. So those realizations are nothing but whatever we get, we will understand the structure of receipt and then allocate with respect to payments. So that done in different tranches or different installments. That's why it's understood as a piecemeal payment. That is, part of it is being settled. So what does it say here? Generally, the assets sold upon dissolution are realized only in small installments over a period of time. So this is what is practically possible. In such circumstances, the choice is either to distribute whatever is collected or to wait till the whole amount is collected. So it purely depends on the partnership firm to distribute as and when you're realizing the asset. That is, as and when you're selling the asset one by one, you get some money, immediately you use that to settle it off. Or wait until the complete assets which is present in the firm is sold. So the choice purely depends on the firm. Usually the first courses is adopted. If there is piecemeal structure, first course is nothing but as and when you sell the asset, you realize the money and use that to pay off the liability. In order to ensure that the distribution of cash among the partners is in proportion to their interest in the partnership concern, either of the two methods described below may be followed for determining the order in which the payment should be made. So here what it says is, with respect to this settlement, there are two methods available for piecemeal distribution. One is maximum loss method, another one is highest relative capital method. Either of the two methods can be approached by the firm in order to settle it. Order of payment, it will be same thing what we discussed. First will be towards realization, then outside liabilities, then partners loan, and then partners capital. This is the same point what we just understood in the beginning. So there are two methods as mentioned with respect to piecemeal payment. One is maximum loss method, another one is highest relative capital method. Maximum loss method. What does this maximum loss method tell? Each installment, whatever you realize, after that installment is taken, remaining amount which is outstanding, that will be treated as maximum loss. And then there is a loss. Definitely there will be a deficiency for any of the partner. Deficiency means negative balance. Now that will accordingly be treated again with the use of Garner versus Murray rule or in their profit sharing ratio. So this is maximum loss method. I've just told you what it means. You will definitely not connect on how to apply this until we solve this in the question. You will understand properly about maximum loss method while we solve the question. Next, highest relative capital method. Now, this again focuses on distribution to partners, but here the importance is given on their capital balances. So, what we are supposed to do under this method is we will consider the capital balances or capital investment made by the partners present in the business. We will take their profit sharing ratio. First, understand what is their per unit of share, and then with the per unit of share, we will take any one of the capital which is least as base and find out proportionate capital. So this method is also called as proportionate capital method because of this step. So taking that proportionate capital method, we will understand something called as excess capital. So how much extra the partner has invested, minimum required is so much, but how much extra the partner has invested. So considering that, we will understand the ranking, who takes the first order in receipt of installment. So this is done since on the capital balances. That's why this method is understood as highest relative capital. Whatever points I discussed is nothing but mentioned here You will connect it, or this makes more sense after you understand the steps used to solve. So once we solve, you can just give one reading to whatever is mentioned here. You'll be able to connect it well. I hope the summary of explaining the steps is clear to all of you. As we solve the question, you will definitely get it in a much better way. Now, these were all the concepts with respect to dissolution. Now, let's move to questions. Each question has majority same steps, but you should make sure that you look into what is different from question to question and what point holds relevance to summarize or revise this. Clear? Yes. Amit, Sumit, and Kumar are partners sharing profits and losses in the ratio of 2 is to 2 is to 1. The partners decided to dissolve on 31st March 22 when their balance sheet was as under. So they are giving us the balance sheet here. The following information is given to you. Realization expenses amounted to 18,000, out of which 3,000 was borne by Amit. Creditor agreed to take over furniture of book value. The rest was paid. The other assets realized given. For half of his loan, D accepted plant and machinery and 7,500 cash. The remaining amount was paid at a discount. Bills payable were due on an average basis of 1 month after 31st March, but they were paid immediately on 31st March at 6% discount per annum. Prepare the realization account, bank account, and partners' capital in the books of partnership firm. So, unlike you see in the other units of partnership, here they will definitely not ask for balance sheet because the business is getting closed. To understand how it will be solved properly, your judgment pointer would be bank account. What all payments, what all receipts will be realized or paid will be impacted in the bank account. So that will definitely ultimately match on both sides with respect to receipts and then payments. So this indicates that whatever amount or treatment given with respect to the items of partnership business would be right. Whatever I told now, you will understand after we complete the questions. There are a good set of points which definitely requires one-time practice from your end. First, understand how to solve after we solve it here, and then also practice from your end as well. So they're asking us realization account, debit, credit, partners, capital. There are three partners, Amit, Sumit, and Kumar. And then there is bank account. This is normal dissolution. Still, we have not come across an insolvency question. Yes. So these will be the main necessary ledgers. Depending upon what details are available in the question, we can make working notes. Likewise here, Amit, Sumit and Kumar are three partners. If you observe for Amit and Sumit, there is a credit capital balance, but for Kumar, there is a debit capital balance. This is very much important to observe whether there is partner's loan present. See, there is Kumar's loan account. This connects to the point which we just understood with respect to treatment of partner's loan. So we will come to that as well. So if this is the case, it is always better to present this as a working note. What Kumar's loan account. Now, first step in dissolution will always be to clear the balance sheet. We will first do that. We will first take the asset side. So realization to all assets. Land and building 1,35,000. Land and building 135. Then we have plant and machinery 45,000. Later furniture 25,500. Then we have investments 15,000. Then we have book debts. Understand, we have to transfer only gross value. So we have to be very careful here. To book debt 60 and provision for bad debts is 6. book debts 60,000, buy provision for bad debts 6,000. Then we have stock 36,000. Later we have bank. Remember, this will not be transferred to realization. We have opened a separate account, so we will take up the balance there. Bank to balance brought down 13,500. Then we have capital withdrawn, Kumar, debit balance. So we can present that in the capital account. To balance brought down for Kumar, it is 32,400. Now, if you observe, what did we do? We just cleared all given on the asset side. Likewise, on the liability side, capital account balances are given 55,200 for both. So, by balance brought down 55,200, 55,200. Then we have general reserves. This should be transferred to partners capital 61,500. Their profit sharing ratio is 2:2:1. By general reserve 61,500 into 2:2:1. So 2 by 5. 24,600. 24,600. 12,300. Next, Kumar's loan we have. So it is better always if there is partner's loan to make it as a working note and present that in ledger. Kumar's loan account, debit, credit. Loan will have a credit balance. So by balance brought down 15,000. Remember, when the capital has debit balance, that it is a receivable to the firm. There is loan, which is a credit balance payable by the firm. So we will just net it off. So this will be transferred to partner's capital account because that is how it will be settled. We understood this in the concept. 15,000 to Kumar's capital account. 15,000. So Kumar's loan to Kumar's capital. So by Kumar's loan 15,000. Next point, loan from D. D is an outsider. So this is an outside liability. 1,20,000. By loan from D, 1,20,000. Trade creditors 30,000. Bills payable 12,000. Trade creditors 30. Bills payable 12,000. Outstanding salary 7,500. By outstanding salary 7,500. So this completes all items in the balance sheet. Now let's move to what is given in the information. Realization expenses amounted to 18,000, out of which 3,000 was borne by Amit. Who is Amit? One of the partners. So what will be the journal entry for this? Realization account debit, because expense is represented there. 2. Cash or bank, that is bank account is created, 15,000, and balance 3,000 will go to Amit's capital. So realization account debit to bank account 15,000 to Amit's capital. Since 3,000 is borne by Amit, 3,000. We can write this as dissolution expenses. Since I have here taken Amit's capital, we will also reflect this entry simultaneously. See, if you enter it as and when together, it becomes easier since we cannot miss any point here. Realization to bank means by realization in bank account, by realization 15,000. So this is dissolution expense, and in partners capital by realization 3,000. So Amit took care of this. So first point done. A creditor agreed to take over furniture of book value 12,000 at 10,800. The rest of the creditors were paid off at a discount of 6.25%. Now remember, exchange of assets and liabilities, that point is relevant here. A creditor agreed to take over furniture of book value 12,000. Furniture for me is available at 25,500. Furniture worth book value of 12 is taken over by creditor at 10,800. That means for that particular transaction, that is part of the credit transaction, there will be no entry. Yes. The rest of the creditors were paid off at a discount of 6.25%. Now, how much is the rest of the creditors? Total creditors present was 30,000. In this, furniture worth 12,000 was taken at 10,800. So the balance creditors are 19,200. These creditors were paid off at a discount of 6.25%. So that means minus 6.25%. So they will be settled at 18,000. So how will this be reflected? Realization account debit to bank account. Creditors 19,200 minus 6.5%. How I got 19,200? It is nothing but 30,000 minus 10,800. So this minus 6.25%. So this will be 18,000. So since I've taken it to bank, by realization 18,000. Next, the other assets realized as follows. Furniture remaining taken over by Kumar. Kumar is a partner at 90% of book value. See, part of the furniture was used to settle creditors. How much of book value? 12,000. Furniture is showing at 25,500. In that, if I take out 12,000, the balance is 13,500. This is taken over by Kumar at 90% of book value. That means 90% of 13,500 will be 12,150. So what will be the entry for this? Kumar is taking away the asset. So if you are selling the asset, you would have debited bank. Since partner is taking, so partner's capital account to realization. So by Kumar's capital account, this will be at 12,150. How did we get this? 25,500 minus 12,000 into 90%. 25,500 minus 12,000 into 90%. Yes. By Kumar's capital. So in Kumar's capital, we will represent it as to realization. 12,150. Furniture. Then Stocks realized 120% of book value. So stock is presented at 36. So 120% is realized by bank. We can just take one entry for this and write down the value of asset. Stock is 36,000 into 120% will be 43,200. Then book debts, 12,000 of debts proved bad, remaining were fully realized. That means 60,000, 12,000 was proved bad. So you take out that 48,000. Book debts, 48,000. Then we have land and building realized 1,65,000. Land and building. Then we have investments taken over by Amit at 15% discount. Amit is a partner. So what will be the entry? Amit's capital to realization. So all other things realized by Amit's capital. Investments at 15% discount. Investment is shown at 15,000. 15,000, 15% discount. So 12,750 to realization. This will be investments 12,750 for Amit. So this is done. Next, for half of his loan, D accepted plant and machinery and 7,500 cash. Plant and machinery was available at 45. He completely took that, so there will be no entry for this. Remaining was for cash. So what will be the journal entry? Realization account debit to cash account for 7,500. This is with respect to D's loan, which was worth 1,20,000. The remaining amount was paid at a discount of 10%. So let's understand this. Half of his loan, D accepted plant and machinery. Loan of D was 1,20,000. 50% is 60. For this, he accepted plant and machinery and 7,500 cash. Remaining was payable at 10% discount. How much was remaining? 60,000 was paid at 10% discount, means 54,000. Clear? So can we just pass one entry for this, since there is cash involved here and there is cash involved here also. 7,500 and then 54,000. 60,000 is nothing but the other half. If I take out 10%, so balance will be 54,000. So 54,000 plus 7,500 will be 61,500. Loan from D was a liability. So what will be the entry? Realization account debit to cash or to bank. To bank account. That is 61,500. This is 7,500 plus 54,000. For plant and machinery, there will be no entry. Yes. Bills payable were due on an average basis of 1 month after 31st March 22, but they were paid immediately on 31st March at 6% discount per annum. Bills payable was your outside liability. This was due on an average basis of 1 month after 31st March, that is beyond your dissolution date. But they paid it immediately on 31st March at 6% discount per annum. Understand this carefully. It was due 1 month. That means if they are giving you the discount percentage per annum, means this is for whole year. You have to just take it for 1 month. So what is the bills payable value? 12,000. So 12,000 into 6% into 1 by 12. So 60 rupees. This was due on an average basis. This were paid immediately on 31st March for 6% per annum is nothing but how much you are able to realize for 1 month? 60 rupees. To bank account. $12,000 into 6%. into 1. Bills payable is settled for 1 month's discount. So this will be this is 12,000 minus this value 1 by 12. So this will be 12,000 into 6% into 1 by 12 is 60 rupees. So 12,000 minus 60. This is 11,940. By realization 11,940. With respect to loan of D, that is also not entered, 61,500. 61,500. This is bills payable. So totally there were 15, 18, 15, 18, 11,940 and 61,500 entered. Further, this was all the points. Now, once we have completed whatever details are given with respect to information, it becomes very, very important for you to tag it one by one. Remember the assumption, if the liabilities, with respect to liabilities, if nothing specified, we will assume it to be paid off. Provision is just an entry which is structured, so there will be no payment with respect to that. Loan from D settled. Trade creditors was also taken care. Bills payable done. Outstanding salary. There was no treatment for this. So if nothing specified, we will assume it is paid. So to bank 7,500. At book value itself 7,500. By realization outstanding salary 7,500. So with respect to assets, there is no such problem. So all values taken care. So we will just take the total here. 43,200 plus 48,000 plus 1,65,000. This will be 256,200. By bank, to realization 256,200. 2,56,200. This is sale of assets. So we have considered all the entries which has to impact realization account. Let's close the realization account. 6,000, 1,20,000, 30,000, 12,000, 7,500, 12,150 plus 2,56,200 plus 12,750. This is 4,56,600 minus 1,35,000 minus 45,000 minus 25,500 minus 15 minus 60 minus 36 minus 15 minus 3 minus 18 minus 61,500 minus 11,940 minus 7,500 is 23,160. This is your realization profit which needs to be transferred to partners capital in their profit sharing ratio. Amit, Sumit and Kumar. So into 2 by 5, their same profit sharing ratio 2 is to 2 is to 1. 9264, 9264, 4632. So this will appear in the partner's capital by realization. This is profit 9264, 9264, 4632. So all entries which are supposed to be done in the capital is also considered. So we will close the capital account. See, the order of closing accounts in dissolution will be first your realization account. Then if there are any working notes which you have opened with respect to current account, capital account, partners capital, at the end will be your bank account after realizing and paying off the liabilities. Kumar, 12,300 plus 15,000 plus 4,632. You will have 31,932. There is more on debit side, 32,400 plus 12,150. 44,550 minus 12,300 minus 15,000 minus 4,632, 12,618. Understand one thing, guys. Here there will be no balances carried down because we are not presenting this in the balance sheet. This will be either paid off to partners or the partner is bringing additional capital. So since this balance is coming on the credit side, so Kumar will bring in additional capital. 55,200 plus 24,600 plus 9,264, 89,064, 89,064, 55,200 plus 24,600 plus 3,000 plus 9,264. This is 92,064 minus 12,750. This will be 79,314. To bank account. If it is to bank, it means paid to partners. So this will be reflected in my bank account. Partners capital to bank. So by Amit's capital. By Sumit's capital. Amit had 79,314. Then Sumit 89,064. Kumar bought in the capital. So to Kumar's capital account. 12,618. Now let's check the total. 89,064 plus 7,500, 61,500, 11,940, 18, 15, 282, 318. 282, 318. So if your bank account tallies, it is just an indication that whatever treatments you've made is correct, because ultimately every account is getting closed in dissolution. So bank account will be at the last resort. Why? Because we will have to record all the realization and settle whatever dues are supposed to be provided. So both sides 15,000 plus 18 plus 11,940, 61,500, 7,500, 79,314, 89,064. So 2,82,318. So this completes our question 1. In this particular question, just gave you a basic structure on how to proceed with the dissolution and one treatment with respect to your partner's loan. Because partner had a debit balance. If it was a credit balance, there was no such complication there. Further, P, Q and R were partners sharing profits and losses in the ratio of 3:2:1. No partnership salary or interest on capital is being allowed. So this is as per the deed. Their balance sheet on 30th June is as follows. They are given as fixed capital. Observe this carefully. So fixed capital is given. Further, current account balances are also given. For two partners, there is credit balance. For one partner, there is debit balance. R's current account 400. Further, on 1st July, the partnership was dissolved. Motor vehicle was taken over by Q at a value of 500, but no cash passed specifically in respect of this transaction. Sale of other assets realized, so they are giving us the details. Trade creditors were paid 11,700 in full settlement of their debts. The cost of dissolution amounted to 1,500. Loan from B was repaid. P and Q were both fully solvent and able to bring in any cash required, but R was forced into bankruptcy and was able to only bring one third of the amount due. So there is insolvency, required cash and bank account, realization account, and partners fixed capital after transferring current accounts balances. See, whenever there is current account balances given to you, so same like what we discussed in death of a partner, first transfer, make all the impacts which are supposed to be done in the current account. Anyway, the accounts are getting closed. So we will transfer the balances to the capital account and make all the entries in the capital account. We will do the same steps here. So they have asked us realization. First will be presenting realization. Debit, credit, partners capital, P, Q and R. Then there is cash and bank account, debit, credit. Then we have partners current account. So here there is one loan. So fine. We will do it for P's loan account. Let's make current account. Partners current account. Three partners P, Q and R. Yes. So first step, as we followed in the previous question, let's clear the balance sheet. Asset side, fixed assets. Trademark, 40,000 freehold property to trademark to freehold property. 8,000 plant and equipment, 12,800 to plant and equipment. Next will be motor vehicles, 700. Next, stock, 3,900. Then we have trade debtors. Remember, gross value, trade debtors 2,000, provision 100. By provision 100. Then we have cash at bank 200. To balance brought down 200. Then we have miscellaneous losses. R's current account as a debit balance. To balance brought down 400. On to liabilities. First, capital balance is given 20, 20 and 10. By balance brought down 20,000, 20,000 and 10,000. Then we have current account balances P and Q 500, 9,000. 500, 9,000. This is balance brought down. Next, we have loan from P. P is a partner. So partner's loan will B, prepared as a separate ledger. Observe carefully. P, capital account has a credit balance. P, loan also has a credit balance. So this will be normally paid off 8,000. We have opened the loan account. By balance brought down 8,000. This will be normally paid. So we can finish off this treatment to bank account 8,000 since both has credit balance. If it has a debit balance, remember the treatment what we saw in the last question. So that will be dealt accordingly. 8,000 and 8,000 paid. So since we have reflected this, we can enter this in the bank account. T's loan to bank. So by T's loan. Then trade creditors 12,400. So we have completed all the points of balance sheet. Next, on 1st July, the partnership was dissolved. Motor vehicle was taken over by Q at a value of 500, but no cash passed specifically in respect of this transaction. Motor vehicle value is 700. It is taken over by Q, one of the partner, at 500. So what will be the journal entry? Partners capital account debit to realization. Partners capital account debit to realization. So by Q's capital 500. This is for motor vehicle. So by Q's capital to realization 500. 500. So this is for motor vehicle. Next. Then sale of other assets realized. Trademark, freehold property, plant and equipment, stock and trade debtors. So we can just make it as one entry by bank account. Trademark is nil. Freehold property, plant and equipment, stock and debtors. So trademark is nil, freehold property 753. And 1,600. Trade creditors were paid 11,700 in full settlement of their debts. So to bank account, trade creditors 11,700. That is what the value was. Realization to bank. So by realization 11,700. This is with respect to trade creditors. Yes. Next, the cost of dissolution amounted to 1,500. So here there is just the mention of expenses. So to bank dissolution expense 1,500. Yes. So by realization 1,500. This is dissolution expense. Next, the loan from P was repaid. That is what we have treated. P and Q were both fully solvent and able to bring in any cash required, but R was forced into bankruptcy and was only able to bring 1/3 of the amount due. So this treatment will be dealt in partners capital. So we can first observe With respect to liabilities, there was only creditor, so that is also settled. Now we can close the realization. 7,000 plus 5 plus 3 plus 1,600. This total is 16,600. By bank to realization 16,600. 16,600. This is sale of assets. Let's total it. 100 plus 12,400 plus 500, 16,600. 29,600 on the credit side. 40,000 plus 8,000, 12,800, 700, 3,900, 2,000, 11,700, 1,500 is 8,600. Remember, when there is insolvency, you will get realization loss only. 8,600 minus 100 minus 12,400 minus 500, 16,600. This is 51,000. By partners capital account, there is P, Q, and then R. 3:2:1 is the ratio, right? Yes. Into 3 by 6, this is 25,500. 51,000 into 2 by 6, 17,000. 51,000, 8,500. By partners capital to realization. To realization loss 25,500, 17,000, then 8,500. There was no such reserves in the question. There is nothing else available. Yes, with respect to P&L account, this needs to be transferred first to partner's current account, 12,000, distributed in the proportion of 3:2:1. So, profit and loss account will have a debit balance. If we have to eliminate, we will have to credit. So, what account will be credited? Partner's current account. So, we will first reflect that entry in the current account to profit and loss account. This has debit balance. So profit and loss account debit balance was given at 12,000, 3:2:1 ratio. 12,000 into 3 by 6, 6,000. 12,000 into 4 by 6, 12,000 into 2 by 6, sorry, 4,000, and then 2,000. So we will find out the closing balances. 2,400. Then we have 9,000 minus 4,000 will be 5,000. 500. 6,000, 6,000. 6,000 minus 500 is 5,500. By partners capital account, and then to partners capital account. So we will transfer this to partners capital. By partners capital to current account means, so this will appear on the debit side, 5,500 and 2,400. To partners current account, 5,500, 2,400. By partners current account, so 5,000 for Q. Yes. So this we have transferred from partner's current account. All entries done. Now we have to calculate deficiency. The question informs that R is a deficient partner. How do we calculate deficiency? Total of debit side minus total of credit side. 8,500 plus 2,400 minus 10,900 is the deficiency. Some amount is realized is also given. So we will make a working note. Deficiency of R is equal to total of debit side is 8,500 plus 2,400, which is 10,900, and total of credit side is 10,000. So 900 minus realized from R's. What is the wording given in the question? From realized from R is 1/3 of the amount due. 900 was due. So 1/3 of this is 900 into 1 by 3. So this will be 300. Remaining is 600, which is outstanding. This is deficiency to be borne by solvent partners in capital ratio. Now, what were the steps of applying Garner versus Murray? First, the solvent partners should bring in capital equal to the realization loss. So who are the solvent partners? P and Q. So there was a realization loss of 25,500 and 17,000. So when they bring in additional capital, what will be the journal entry? Bank account debit to solvent partners capital account. So first, by bank. So this will be 25,500 and 17,000. So this is the first step. Since we have routed through bank, we will pass the entry there. 2P's capital, 2Q's capital, 25,500 and 17,000. 2P's capital and 2Q's capital. Done. Then this is the first step. Second step, we found out the deficiency. That is to be borne in capital ratio. In the question is clearly communicating the capitals are maintained on fixed basis. So if there is a capital maintained on fixed basis, we have to take the ratio on fixed capital. So the ratio for solvent partners is 2:2. So in simple words, 2:2:1. Fixed capital ratio is 2:2:1. So what will be the capital ratio to bear the deficiency between P and Q? It will be 2:2. This 600 will be borne as 2 by 4 and then 2 by 4 P and Q. So 300 by P and 300 by Q. So what will be the journal entry for this? Understand R's capital is showing debit balance. So who is contributing P and Q? So when they are contributing, their balances will come down. So what will be the journal entry for this? P's capital account debit, Q's capital account debit to R's capital account. So this will be the journal entry. So this will be reflected in the capital account. So 2R's capital $300 and 300. This is deficiency borne. Then by P's capital account by Q's capital account, which is 300 and 300. Remember, there was something bought in by R bought in cash. So for that also we have to reflect the entry by bank 300 in R's column. So by bank 2 R's capital 300. So we have done the insolvency treatment. What was the first step? Introduce additional capital by solvent partners equal to realization loss. This is the first step. Then we found out deficiency. How to find out deficiency? Total of debit balance minus total of credit balance. Subtract if there is any amount realized. So balance will be apportioned between solvent partners and capital ratio. In this question, fixed capital is there. So we understood fixed capital balances. 2:2 was the ratio equal. So 600, which was the deficiency borne by P and Q, 300 and 300, that has been reflected. This is the deficiency entry. Clear? Okay. Now we will close the ledger. For insolvent partners, it will definitely get automatically closed because the new partners have brought in additional capital, and then he was also able to realize the amount. See, 8,500 plus 2,400 is 10,900. This side also, if you see, it is 10,900. It gets closed automatically. So for Q, 20,000 plus 5 plus 17,000, 42,000 minus 500 minus 17 minus 300. So 24,200. 20,000 plus 25,500. This is 45,500 minus 25,500 minus 5,500 minus 300, 14,200 to bank account. This will be balancing figure which indicates that payment is made to P and Q. So by P's capital, by Q's capital, $14,200 by Q's capital, 24,200. Entered all the values. Let's total 11,700, 8,000, 59,600. This is 16,600. Yes. $59,600 both sides. In this question, the differentiating point was about applying Garner versus Murray rule. I hope you guys are comfortably understanding step by step. Moving to next question. A, B, C, and D sharing profits in the ratio of 4:3:2:1. Observe there are 4 partners. Decided to dissolve on 31st March when their balance sheet was as under. Creditors, employees, provident fund. So this many students get confused. This is nothing but equivalent to outside liabilities, guys, because this is nothing but a fund maintained on behalf of partnership firms employees. So you will treat it as a normal outside liability. Capital accounts for A and B, there is credit balance, there is debit balances for other 2 partners. Fine. Following information is given. One of the creditors took some of the patents whose book value was 5,000 at a valuation of 3,200. Balance of the creditors were paid at a discount of 400. There was a joint life policy. Now this we have understood in retirement and death. 20,000 not mentioned in the balance sheet and this was surrendered. So if it is mentioning clearly that it is not given in the balance sheet, that indicates that it is not treated as an asset. So this was surrendered for 4,500 is nothing but the income which we are getting. Remember the concept of unrecorded asset liability. We have to treat it accordingly. The remaining assets were realized. The values are given. All D became insolvent and a dividend of 25 paisa in a rupee. What does this indicate? It is nothing but 25% was received in respect of the firm's claim against his estate. Prepare necessary ledger accounts. When the question gives us just prepare necessary ledger, main things which you are supposed to do is realization, partners capital, and bank account. Additionally, if anything required with respect to working notes, we can accordingly prepare. So realization account, then we have partners capital with 4 partners, bank account. Like we are doing normally, first step is to clear the balance sheet. Bank account 535, so 2 balance brought down 535. Then we have debtors 15,850. Fifteen eight five zero. Stock 25,200. Then we have prepaid expenses 800. Plant and machinery is 20,000. Then we have patents 8,000. There are capital balances given, C's capital and D's capital. Coming on the debit side, we will present this in the capital account. 2 balance brought down. For C and D, so this is 3,200, 8,415. Then we have creditors 15,700. Then employees provident fund 6,300. Then we have capital accounts of A and B 20,000, 40,000 and 20,000. By balance brought down 40 and 20. So what did we do now? We just cleared all the assets and liabilities capital balances given in the balance sheet. Moving on to additional information. One of the creditors took some of the patents whose book value was 5,000 at a valuation of 3,200. One of the creditors took some of the patents. So with respect to exchange of asset for liability, patent's book value was 5,000 at a valuation of 3,200. Balance of the creditors were paid at a discount of 400. For this, there will be no entry. So, what were the total creditors? 15,700. In 15,700, they have considered it for 3,200. Balance is 12,500. This was paid at a discount of 400. So, to bank creditors. So how will we do this? 15,700 minus 3,200. So you will be left with balance of 12,500. So this will be taken at a discount of 400. 12,100. By realization in bank account, 12,100. Creditors paid. Next, there was a joint life policy of 20,000 and this was surrendered for 4,500. So this is nothing but your income. So when you receive the money, when you surrender, the entry would be bank account debit to realization. So by bank joint life policy, this is how much? 4,500. So to realization in bank, to realization 4,500. Joint life policy. Next. We have the remaining assets, debtors 10,800. So by bank, debtors 10,800. Then we have stock 15,600. Plant and machinery 12,000. Patents at 60% of their book value. Understand one thing, patents was given, a part of patents was given to creditors. What was the total patents? 8,000. In 8,000, 5,000 was set aside for payment to creditors. You are left with 3,000. This is taken at 60%. So 3,000 into 60% is 1,800. 8,000 minus 5,000 into 60%. Then expenses of realization 1,500 is given. So to bank realization expense. So by realization 1,500. Realization expense. All right. So just to cross check, we had creditors who settled, employee provident fund, no treatment given. So it will be taken over at book value 6,300. Be very careful, guys. There are chances of missing such details. 6,300. Employee provident fund paid 6,300. So by realization, this is towards employee provident fund. Okay. Apart from that, there are no other liabilities. So we can close the realization. 10,800, 15,600, 12,000. 1,800. This is 40,200. By bank to realization. To realization 40,200. This is sale of assets. Yes, all done. Now let's close. Since there is insolvency, there is realization loss. 15,850 plus 25,200 plus 800, 20, 8,000, 12,100 plus 1,500 plus 6,300. This is 89,750 minus 15,700 minus 6,300 minus 4,500, 40,200. This is 23,050 by partners capital account. There is A, B, C and D. Their profit sharing ratio is 4:3:2:1. So 2350 into 4 by 10, 9,220. 2350 into 3 by 10, 6,915. 2350 into 2 by 10, 4,610. 2350 into 1 by 10 is 2,305. So this will be transferred to partners capital account. To realization, this is loss 9,220, 6,915, 4,610, 2,305. So this is done. So apart from that, we have considered all other things which is to be reflected in the partner's capital. So there is no partner's loan. Now treatment of insolvency. Who is insolvent? D. So first step in applying Garner versus Murray, we will have to install, that is solvent partners has to bring in additional capital equal to the realization loss. First we have to understand who are the solvent partners. See, the question is confirming D became insolvent, but C also has debit balance. How do you know, ma'am? See here, C's capital has a debit balance. So therefore, only solvent partners for the purpose of bearing deficiency would be A and B. So A and B will bring in additional capital. So we can first make that entry by bank equal to the realization loss 92206915. Is this understood? So by bank to A's capital to B's capital 92206915. Now let's calculate deficiency. Deficiency of D. So total of debit side 891. This is 8415 or 8915? 8415. Let me write this properly. 8415. 8415 plus 2305. This is 10,720 minus total of credit side is 0. $10,720. In this, the question is specifying that 25% in a rupee was received in respect of the firm's claim against his estate. So minus realized 25%. So 10,720 into 25% is 2,680. 10,720 into 25%. So this will be 10,720 minus 2,680. 8040. Now this to be borne by A and B. In what ratio? Capital ratio. If you observe in the question is maintained on fluctuating basis. Remember, if it is maintained on fluctuation basis, we have to take the capital balances before all dissolution adjustments. Let's observe the capital account. If you observe the capital account, apart from balances brought down, realization and buyback, whatever we have written is due to dissolution. So we can take this itself as the capital balances for the purpose of ratio. So it is 4:2. If I simplify further, it will be 2:1. So this capital ratio between A and B is 2:1. So 8040 into 2 by 3, 5360. 8040 into 1 by 3, 2680. So two treatments. First, for the amount realized from D's estate, 2680 by bank 2680. So 2D's capital 2680. Now what will be the entry for this? A's capital account debit, B's capital account debit to D's capital account. This is 804053602680 to D's capital 53602680 by A's capital 5360 by B's capital 2680. So let's close the capital account. First, for the insolvent partner, 8415 plus 2305, 10,720, 2680, 5360. This is 10,720. Then for C, 3,200 plus 4610, 7810. Since D has debit balance, he has to bring in additional capital by bank balancing figure. B, 20,000 plus 6915 is 26,915. 26,915 minus 6915 minus 2680. This is 17,320. 40,000 plus 9,220. 49,220 minus 9,220 minus 5,360. This will be 34,640. To bank balancing figure. So A's capital, B's capital. $34,640 by B's capital account 17,320. Then to C's capital 7810. 1,200, 1,500, 6,300, 34,640 plus 17,320, 71,860 minus 535, 4,500, 4,200, 9,220, 6,915, 2,680. So 71,860. So difference between this question and the previous question was with respect to deficiency, there was a capital ratio maintained on fixed basis in the previous one. Here we saw on the fluctuating method. So question to question, as you can observe, you have to observe the unique points and just invest time on practicing those. Moving to next one. X, Y, and Z who are in partnership sharing profits and losses in the ratio of 2:2:1. They had the balance sheet, fixed asset, stock, book debt, advance to Y. Y was one of the partner. This is nothing but, what is this? Advance to Y. Coming on the asset side means partnership firm has given loan to the partner. Yes, sorry, partnership firm, yeah. Capital balances of XYZ is given. Z's loan is there. So there is a liability, loan from Mrs. X, and then sundry trade creditors. The firm was dissolved on the date mentioned above due to continued losses. After drawing up the balance sheet given above, it was discovered that goods amounting to 4,000 have been purchased in November, had been received, but the purchase was not recorded in books. One of the important adjustment for this, see when is the balance sheet drawn? 31st December 2022. So what they are observing here is, with respect to the balance sheet which is drawn, 4,000 worth goods which was purchased in November, that is in the year belonging to 31st December 2022 and has been received, but the purchase was not at all recorded in books. That means the entry is omitted, that needs to be incorporated, and then the treatments have to be discussed further. Fixed assets realized 20, stock 21,000, book debt 2,500. Similarly, the creditors allowed a discount of 2% on average. Expenses, X agreed to take over the loan of Mrs. X. Y is insolvent and his estate is unable to contribute anything. Give accounts to close the books. Work according to the decision in Garner versus Murray. So let's apply. Same thing, realization account, partners capital, and then bank account. Debit, credit, So first step is to clear the balance sheet. Realization account, fixed assets 40,000. Two fixed assets. Then we have two stock 25,000. Two book debts 25,000. Provision 5,000. By provision 5,000. Cash balance is given 1,000. So instead of bank, we can write this as cash. To balance brought down 1,000. There is advance to wife. That means firm has receivable balance from partner 4,000. So we can make this as a working note. Advance to wife. To balance brought down 4,000. Now, same like what we were discussing for loan, if the question is not specifying whether it is received or not, see, in order to obtain that information, logically think who is the partner who's getting insolvent? It is wife. So, advance to 5 means it is receivable from wife. First of all, insolvency is a situation where his debit balance is more than the credit balance. So, he is in a position to pay back to the firm. Insolvency is confirmed when he is unable to bring in sufficient cash. Correct? So this is one aspect. Second one, when it is an asset to the firm, that means Y has to still repay back to the firm. So there was one more receivable. Now understand one thing, the partner is insolvent anyway. So can you expect this advance given by this partner to be receivable? Definitely not. So this will also be part of your deficiency. Understand this carefully because partner is anyway becoming insolvent. So anything which is receivable from him is also not to be received because of his insolvency position. So like I was treating for partner's loan, this also I will transfer to partner's capital by, I can just write it as Y's capital account 4,000. So to advance to Y 4,000. 4,000. Done? Yes. So we have completed asset side. Liabilities, capital X, Y and Z 29,200 by balance brought down 29,200. Then we have 10,800 and 10,000. Further, there was debts loan. This is a partner's loan. We will present this in ledger. By balance brought down 5,000. Then loan from Mrs. X 10,000. This is a normal outside liability. Loan from Mrs. X 10,000. Then we have trade creditors. Now before we enter this trade creditors, Let's revisit the adjustment. See, there was creditors with respect to the purchases. When purchases happen, what is the entry we do? Purchases account debit to creditors. Now here it is always feasible to understand this as a credit purchase. So therefore the entry will be purchases to creditors. What the question is specifying is this entry is missing even though the goods have been received. So this entry was supposed to be passed. It is not passed. So now we have to rectify this. See, when purchases which was supposed to be debited not debited means this will definitely impact my profit. Profit will reduce because purchase is an expense. Now, ultimately, where will the profit be transferred to? It will be distributed amongst the partners, correct? So, you will credit to partners' capital. Yes or no? Are you understanding the link here? So, purchase is an expense which will reduce my profit. This profit will be ultimately transferred to partners' capital. So, since I have my capital here, I can directly reflect that by showing this entry. So I will impact this variation due to purchase in the partner's capital account. So the entry, what I can reflect for this will be partner's capital account debit to creditors because I'm not again opening any profit and loss. Is this understood? So this was due to past year adjustment. Now this 4,000 will be taken away in their profit sharing ratio into 2 by 5. 1600. So the actual entry for this will be X capital account debit, Y's capital account debit, Z's capital account debit to creditors account. This is for the revision done. 1600, 800. So this needs to be reflected in the partnership books. So capital account is debited to creditors, to creditors 1600, 1600 and 800. Now with respect to this, what value should we take in the balance sheet since we have revised? Creditors is showing at 25. There is 4,000 which was not recorded. So we will add that 4,000. 25,000 plus 4,000. So this creditors will be 29. I hope this is understood to all of you. Now we have completely addressed all the points in balance sheet along with that one in the adjustment. Fixed assets realized is 20,000. So buy bank. So there is cash here. So buy cash, fixed assets. That was 20,000. Stock 21,000. Then there is book debt 20,500. Then similarly, creditors allowed a discount of 2% on average. So to bank, to cash, creditors is 29,000 minus 2% of this is 580. So 29,000 minus 580, this will be 28,420. Then the expenses of realization come to 1,080. To cash expenses 1,080. First, we will transfer the same impacts in the cash account. Realization to cash 28,420. This is with respect to creditors. Then by realization with expenses. This is 1,080. 1080. Then we had all the assets realized 20,000 plus 21, 20,500. So this is 61,500 by cash to realization. 61,500. This is sale of assets. Next point, X agreed to take over the loan of Mrs. X. So apart from creditors, there was one more liability, loan from Mrs. X. This is being taken over by partner to X capital, 10,000. By realization, Mrs. X loan, 10,000. Then Y is insolvent and his estate is unable to contribute anything. So there is no realization. So all entries in realization done. So we will close. Since there is insolvency, there will be realization loss. 40,000 plus 25 plus 25 plus 28, 420 plus 1080 plus 10,000. This will be 1,29,500 minus 5,000 minus 10,000 minus 29,000 minus 61,500. 24,000 will be transferred to partners capital X, Y and Z. Their profit sharing ratio is 2 is to 2 is to 1 into 2 by 5, 9,600, 9,600, 24,000, 4,800. So this will be transferred to partners capital, realization to partners capital. So by realization account debit to partners capital. Sorry, this will be by partners capital. So to realization loss 9,600, 9,600 and 4,800. So this is all done with respect to the points given. Now we will have to find out the deficiency. First, before that, we will introduce the capital by solvent partners. Who are the solvent partners? X and Z, because Y is insolvent. So we will first bring in the capital equal to realization loss, 9,600 and 4,800. Now find out the deficiency. So there was Z's loan, nothing specified about whether it is paid or not. So we will transfer it to partners capital. To Z's capital account. Z's loan to Z's capital. So by Z's loan 7,000. So this is working note number 3. Deficiency of Y. Total of debit side 1,600 plus 4,000 plus 9,600 is 15,200 minus total of credit side. So this will be 10,800 4,400 is the deficiency. This will be borne by solvent partners X and Z in capital ratio. In this question, there is fluctuating capital. Remember carefully, when we are taking the capital balances, we have to not consider any dissolution impact. But in this question, there was one adjustment with respect to the rectification done. So this will be impacted. This should be carefully considered. So 29,200 minus 1,600, 27,600 will be for X 10,800 minus 1,600, sorry, 10,000 minus 800, 9,200. So this will be the proportion to 27,600 and 9,200. So if we cancel out the 0,276, is it divisible by 92? Yes. So this will be 3:1 divided by 9,200. The ratio will be 3:1. 4,400 into 3 by 4, 3,300 and 1,100. So what will be the journal entry? X capital account debit, Z's capital account debit to Y's capital account. So 2 Y's capital 4,400. So this will be 3,300 and 1,100 by X capital 3,300 by Y's capital 1,100. So all treatments done. Let's close this. 800 plus 4,800. Sorry, this will come to Y, not Z. 10,000 plus 4,800 plus 7,000. So this is 21,800 minus 800 minus 4,800, 16,200. 10,800 plus 3,300, 1,100 minus 1,600, 1,600, 4,000, 9,600, 16,300, 10,800, 3,300, then 1,100, 15,200, 9,600. So here also there is a mistake. So this in Y, 1,600, 4,000, 9,600, 15,200. So there will be a revision in Z's balance. 21,800 minus 800 minus 4,800, 1,100. This is 15,100. So 29,200 plus 10,000 plus 9,600, 48,800, 48,800 minus 1,600 minus 9,600 minus 3,300. This is 34,300. This will be to bank. So X capital 34,300 by Z's capital 15,100. So here, since I'm used to write bank, I've written bank and bank. So just replacing this with cash. So here, this entry needs to be recorded. By cash to capital means 2x is capital. To Z's capital 9,600 and 4,800. 1,000 plus 61,500 plus 9,600, 4,800, 76,009. Small correction here, guys. See here, Z's loan need to be recorded at 5,000. I have transferred at 7,000. So the revised balance will be 10,000 plus 4,800, 5,000. So this is 19,800 minus 800 minus 4,800 minus 1,100. So this will be 13,100. So this will be 13,100. So 28, 420, 1,080, 34, 300, 13,100. So now it will match at 76,900. So this transfer balance, there was an error. So 7,000 I had taken. So actually the loan amount is 5,000. So in this question, what was the additional point was with respect to past adjustment of creditors, and wife who was an insolvent partner also had the loan being advanced by the firm. So even that becomes part of the deficiency. If you observe, since we have taken it here, advance to wife, this also gets calculated as part of your deficiency. These are the two important points which you need to consider and observe carefully in this question. Next question is about piecemeal payments, maximum possible loss method. Let's understand how to solve. I had explained you in the concepts. Whatever amount is realized, balance will be considered as the maximum possible loss from the firm. How to do it? Let's understand. A, B, and C are partners, sharing profits and losses in the ratio of 5:3:2. Their capitals were 9,600, 6,000, and 8,400 respectively. After paying creditors, the liabilities and assets of the firm are. Liabilities are given, spouses of partners. This is nothing but outside liability. This is for interest on loan from spouses of partners, and then there is also partners loan. Then there is investments, furniture, machinery, and stock. The assets realized in full in the order in which they are listed above. So this is what we understand with respect to piecemeal payments. Every asset present in the balance sheet will not be realized at one shot. It will be realized in installments. What they are telling is it is realized in the order presented here. They are listed above. B is insolvent. You are required to prepare a statement showing the distribution of cash as and when available, applying the maximum possible loss procedure. So for you in the question, they will clearly mention the method of piecemeal payment. So accordingly you have to do. But with respect to the format of presenting the distribution statement, it will be same, guys. So let's understand how to solve this. We have to just present this in a statement. So my first column will be with respect to particulars. Then for realizations, then we will write down all the liabilities, and then last will be capital. There are two liabilities. One for interest on loan from spouses, and then partners loan. Then there are three partners. Realization. Yes. This will be your particulars. Realization, that is what amounts we receive. Interest on spouse loan. This is interest on partners loan. Then we have partners capital balances. A, B, and then C. So first we will write down the balances provided. See, if you observe in the question also, there is no cash balance available at all. So this is the minute things which you need to observe. So interest on spouse loan is 2,000. Partners loan is 1,000. Capital balances are given which is 9,600, 6,000, and 8,400. So these what I've written is just the balances. First, we will start with realizations. Order is mentioned as it is placed in the balance sheet. First one is with respect to investments. So in the question, have they given any details of realization expense? See, always the first priority, the order will remain same. There was realization expense. In this case, there is no expenses mentioned, so we will directly move to outside liability. First, sale of investments. How much we realized? 1,000. So this I can pay only to interest on spouse's loan. Nothing for the remaining. After settling 1,000, I will be left with 1,000 balance. I will again bring down the same balances, 6,000 and 8,400. Next is furniture. Sale of furniture. Realized how much? 2,000. Now I had 1,000 of spouse's loan. First I will settle that. So here also let me write paid for spouses interest on spouse's loan 1,000. So sale of furniture, paid balance interest on spouse loan 1,000. So I will be left with one more 1,000. This will be settled for partner's loan. Paid for interest on partner's loan. See, what am I doing? Just realizing the sale of assets and paying off in the order. So after this, if I have to look at the balances, all settled with respect to outside liability, partner's loan, and now I'm left with capital balances. Then next, machinery 1,200. Now comes the actual picture of applying the methods. See, as per maximum loss method, as we discussed, whatever installment realized, the balance what the partners prefer is that is their maximum loss. So first I will have to find out what is the total requirement with respect to capital balances. 9,600 plus 6,000 plus 8,400, 24,000. So maximum possible loss is 24,000 minus. From this realization, I'm only getting 1,200. This is what they expect as maximum possible loss. 22,800. So be it realization, profit or loss, this is as good as realization. Should be transferred to partners' capital in their profit sharing ratio. So what is their profit sharing ratio? 5 is to 3 is to 2. So 22,800 will be apportioned in 5 is to 3 is to 2 into 5 by 10. Just a minute. So I will have to move this slightly here. Yes. So 11,400. This is 22,800. 22,800 into 5 is to 3 is to 2 into 3 by 5. This is 13,600. Then 22,800. 2 by 5. 9,120. 22,800 into 5 by 10, 11,400, 22,800 into 3 by 10, 6,840. Some wrong values have taken, so just check. This is 6840. 22,800 into 2 by 10 is 4560. Now, after considering the maximum loss, we will have to find how much is the capital balance available. 9,600 minus 11,400, negative 1,800, 6,000 minus 6,840, negative 840, 8,400 minus 4,560. There is positive 3,840. Now, if you remember applying the provisions of Garner versus Murray's rule, what does the point says? 8,400 minus 4,560. Yes, 3,840. What does the provision say? Capital balances which is turned out to be debit, that is negative, should be borne by the solvent partners in their capital ratio. Now, if you observe, both capital balances of A and B are showing negative. So, this will be borne by which partner? By solvent partner C, 3,840. So, 3,840 minus 1,800 minus 840. Deficiency borne by C. So 1,800 will be given, 840 will be given, 1,840 minus 840. Now after we do this, if you observe, so this balance will be 0, this balance will be 0, 3,840 minus 1,840 minus 840. Sorry, this is 1,800. 3,840 minus 1,800 minus 840 is 1,200. Now, if you observe, by selling the machinery, how much is my cash realized? 1,200. Now, what we did here was the hypothetical calculation with respect to whom, which of the partners we have to provide this. So, by solving this as per maximum loss method, we understood that this 1,200 should be paid to whom? Should be paid to C. Paid to C. 1,200. Clear with this? So this balance, after we do this calculation, if you observe, whatever we did from maximum possible loss is just to understand to which partner we are supposed to pay. So now actual outstanding balances of partner was this much. We have to compare this with any outflow and then find out the proper balances. 9,600, nothing was given to A. So A will carry forward with 9,600. Further, 6,000, nothing was given to B again. So B will also continue with 6,000. For C, 8,400 was outstanding. We paid 1,200 to C. So remaining is 7,200. I hope each one of you is understanding what we are doing. So this was with respect to sale of machinery. Further, we have stock sold at 4,000. We will have to follow the same steps. Sale of stock 4,000. So we have to first find what is the maximum possible loss. This is the maximum realization happening. 9,600 plus 6,000 plus 7,200 is 22,800 minus 4,000. This is 18,800. Now this need to be apportioned between partners in their profit sharing ratio. 5:3:2. 18,800 into 5 by 10. 9,400. 18,800 into 3 by 10. 5,640. 18,800 into 2 by 10. 3,760. So after attributing, I have to check the balance. 9,600 minus 9,400, 200 positive. 6,000 minus 5,640, 360 positive. 7,200 minus 3,760, 3,440. Now, if you observe, none of the partners have got negative balance. Now, let me total this up. 3,440 plus 360 plus 200. So, if you take the total, it is again coming to 4,000, which is nothing but the actual amount realized from the sale of stock. So, we can portion in the same value. Paid to all partners in the same proportion in what they've got. 200, 360 and 3,440. So comparing this with the balance which was outstanding, 9,600 minus 200 is 9,400. 6,000 minus 360, 5,640. 7,200 minus 3,440. This is 3,760. Ultimately, this is nothing but we are loss. Loss of partners, which we actually find out in the realization account. See, this is how we solve it as per maximum possible loss method, wherein you consider that after each installment, the remaining amount, comparing this with the total capital balance as the maximum possible loss. What are the steps? First, you take the realized value, take the total of capital. So you will find out maximum possible loss. That needs to be distributed amongst partners in their profit sharing ratio, which will help us find out the deficiency. So with the partners who's having a positive capital balance, which will be a solvent partners, we will apportion the deficiency, same like the application of Garner versus Murray rule. So we will do that in the capital ratio. Second case, same step again. When we further realize, we will find out the maximum possible loss, distribute the maximum possible loss among the partners in their profit sharing ratio. If there is any deficiency, will be borne by solvent partners. In this case, all partners had got positive balance. If we check the total, it was equivalent to the amount realized and we distributed the amount in the same proportion. I hope you understood the structure of solving. Just practice this from your end, guys. So this was maximum possible loss approach. Now let's understand highest relative capital method. A partnership firm was dissolved on 30th June. Its balance sheet on the date of dissolution was as follows. So they're giving us the details. The assets were realized in installments. As soon as you see, it is nothing but connecting to piecemeal payments, and the payments were made on the proportionate capital basis. If you remember, I had also underlined that highest relative capital, otherwise also called as proportionate capital method. Creditors were paid 29,000 in full settlement of their account. Expenses of realization were estimated to be 5,400, but actual amount spent was 4,000. So this expense of realization were estimated to be 5,400 will be while you had already started with respect to distributing the realized amount with respect to the payments which need to be made. But at the end, after they completed the process, they understood that realization expenses was only 4,000. So understand one impact here. Whatever they estimated would have set aside before. So there is a saving of 1,400 which gets added back to the assets realized value. This amount was paid on 15th September. Drop a statement showing distribution of cash which was realized as follows. So they have given the various installments realized. The partners shared profits and losses in the ratio of 2:2:1. Prepare a statement showing distribution of cash amongst the partners by highest relative capital method. See, compared to maximum possible loss and highest relative capital, same format of statement will be prepared. But additionally, there will be one working note in order to find out the highest relative capital that is done on proportionate basis. So this difference is nothing but with respect to working note. Let's understand how it is being solved. So as I mentioned, the same format of statement will be drawn. First one for particulars. This becomes easier to draw. Then we have realization. What were the liabilities? B's loan account and then sundry creditors. So there was realization expense. Three partners. Yes. Particulars, realization. We had creditors. Then there was B's loan, partners, capital, A, B, and then C. So first, let's write down the balances. For sundry creditors, 30,000 and B's loan, 10,000. Partners capital, 76, 48, 36. Yes, we have just written down the balances which is given. If you remember, guys, in the previous question, there was a point with respect to cash balance. In the previous question, when we understood with respect to maximum possible loss, there was no cash balances available. In this, there is 10,800 cash balance. So we will first take this into consideration and then go with realization of subsequent assets. So cash, we can first use it 10,800. Now in this 10,800, if we observe, so first is expenses of realization, which is need to be estimated at 5,400. So first we will set this off, because always the first priority is for realization expenses. So realization expenses 5,400. 10,800 minus 5,400, we will still be left with 5,400. So first preference after providing for realization expense will be with respect to creditors. So this can be used to pay to creditors 5,400. So after completing the cash realization, this is nil. So 30,000 minus 5,400 will be 24,600. I will bring down the same balances: 10,000, 76, 48 and 36,000. So next, first installment. This first installment will be 25,200, which will be utilized towards first settling creditors. If you observe in the question, the total creditors were 30,000, but the question clearly specifies creditors were paid. See, the creditors amount was 30,000. Creditors were paid 29,000 in full settlement. What does this indicate? 1,000 is with respect to discount they are being provided. So the expected amount required will just be 23,600 and not 24,600, because 1,000 is discount. So paid to creditors 23,600. So here I will use 23,600. 1,000 is my discount towards creditors. So balance left 25,200 minus 23,600 will be 1,600. This is nil. 10,000, 76, 48 and 36,000. This will be used to pay to B's loan. 1,600. So 10,000 minus 1,600, 8,400, 76,000, 48 and then 36. So using first installment, we have cleared creditors and then part of B's loan. Second installment is 60,000. Now in this first, I will settle B's loan, which is 8,400. So this will become nil. 76, 48, and then 36. So 60,000 minus 8,400 is 51,600. Now this 51,600 has to be apportioned to partner's capital. Under highest relative capital method, we have to prepare a statement in order to find which partner will receive how much of the amount and in what proportion. So for this, we have to prepare a working note. This is to find out the proportionate capital. So A, B, and C, 76, 48, 36. So this is capital balances. What are we going to do from this statement is we are finding out the capital on proportionate basis. That is, which partner gets the first priority and what is their order of payment. So first, their profit sharing ratio. Profit sharing ratio is given as 2:2:1. Now what we will do is we will find out proportionate per unit share. That means if I have to apportion in their capital ratio, what will be the value? 76,000 divided by 2 will be 38,000. 48,000 divided by 2 will be 24,000. Then 36,000. Now this is called per unit share. What will I do next is I will find out the proportionate capital. Now what is this proportionate capital? See, if I have to observe for A, B and C, there is nothing common factor because A is taking two second part for 76,000 and B is getting 2/5 for 48,000, whereas C is taking 36 for 1/5. This is their capital balances. Now if I have to make the basis common, I will take the least of the capital. Compare that with how much should have been bought if this was the minimum capital. Now, if I observe from three capital balances 38, 24, and 36, 24,000 is the least capital. I will take that as a base. So, if I have to bring for one share 24,000, if A requires 2/5, what is his proportion? So, how will I find out 24,000 into 2? So, proportionate capital will be 48,000. Then 24,000 into 2, 48,000. 24,000 into 1 will be 24,000 itself. Now we will find out the excess capital. This was the proportionate capital. Whatever we have calculated now is the proportionate capital if I take one person least capital as the base. If I had to want two shares, how much is required? Excess capital. Comparing this with the existing capital balance and what should have been the proportionate capital. So 76,000 minus 48 is 28,000. 48,000 is compared with 48, so there is no excess. 36,000 minus 24,000 is 12,000. So these are the excess capital of A and B. Now I understood B is not getting the first order in the payment structure. But between A and C, who should get how much is still not clear. So again, we'll follow the same step. We will take proportionate capital, taking one person capital as base. So 12,000 is the least capital. 12,000 for 2 will be 24. 12,000 for 1 is again 12. So if I have to find out excess capital here, Comparing this with 28, there is 4,000 excess capital for A, nothing for B. For C, there is nil. So now this gives us a clear structure that 4,000 in priority will be first given to A. I hope this point is clear. Further, if I pay 4,000 for A, understand this carefully. If I pay 4,000 for A, balance if I have to check later on. For A, 28 is outstanding. 4,000 if I pay is 24,000 for A. And for C, nothing is being paid. 12,000 will be for C. So if you observe now, 24,000 and 12,000 is coming as the second priority. So therefore, if I understand this or structure this in distribution sequence, so first A 4,000, whatever is the due will be given. First installment, second installment for A and C in the proportion of 24,000 and 12,000. If I have to express this in ratio, this will be 2:1. So subsequently, that is beyond 24 plus 36, sorry, 24 plus 12,000 is 36,000 plus 4,000. Beyond this, subsequently above 40,000, there is no again order. If you follow until here, your capital will be on the profit sharing proportion. So we will take it in the profit sharing proportion itself, that is 2:2:1. So in order to find this out, we just made this table. So what is the structure? We first took the capital balances, found out per unit of share with respect to their profit sharing ratio. Then took one of the partner's capital as a base who has least balances, take it as a proportionate basis. So 24,000 for 2, 24,000 for 2 and 1. So this gave us the proportionate capital. We compared this with the available capital balances. So that gives us the excess capital balance. So we found that out. Then again, since we got two partners capital balance, we again repeated the same structure, took one of the capital as base, compared that with the profit proportion and found out the proportionate capital, then found out the excess capital, which is bringing down to one of the partner. So this gives us the distribution, gives me the order of preference. So using this, I will pay to the partners. 51,600 is available. First preference, I will use it to pay to A, which is 4,000. 4,000 paid to A, 51,600 minus 4,000, I will be left with 47,600. So next will be paid to A and C, 36,000. I have understood the ratio, 24 for A and 12 for C. 51,600 minus 4,000 minus 36, I am left with 11,600. So this will be paid to A, B and C in 2:2:1. 11,600. 2 by 5, 4,640. 4,640. 11,600 divided by 5, 2,320. So I will find out the balance. 76,000 minus 4,000 minus 24 minus 4,640. 76 minus 4 minus 24 minus 4,640. This is 43,360. 48,000 minus 4,640. 36 minus 12 minus 2,320. This will be 20,770. Now, if you observe, this is reflected in their profit sharing proportion. Next installment is 80,000. Third installment, 80,000. Yes, now we have the third installment, 80,000. Remember guys, in the question, earlier they had estimated the realization expense to 5,400. The actual amount spent was 4,000. So there is a saving of 1,400, which we also add to this saving of estimated expense 1400. So the total amount available will be 81,400. Now after apportioning in the order, we now have this 43,360, 43,360 in their capital proportion. If you observe, you can just summarize this. So this is nothing but coming to the same ratio, that is 2 is to 2 is to 1. So therefore, we will distribute paid to A, B and C in the ratio of 2 is to 2 is to 1. So 81,400 into 2 by 5. So this will be 32,560 for A, 32,560 for B, 81,400, 16,280. So balance 43,360 minus 32,560, 10,800, 10,800, 2770 minus 16,280. This will be 4,490. This is what loss of partners. So this is how we solve it if it is asked as per highest relative capital method. So just to summarize what we did, with respect to the table, it is the same format what we understood under maximum possible loss. Just the additional point in highest relative capital, we worked it on a proportionate basis, understood this order of sequence. So with this order of sequence, we first distributed using second installment. So after distributing second installment, your capital balances would have arrived on proportionate basis. So therefore, at the last, we apportion this in their profit sharing ratio 2 is to 2 is to 1. Because beyond 40,000, that's what we had decided on. So after providing, each partner has the relevant loss, that is 10,800 for A, 10,800 and 4,490 for C. So if you observe guys, we have definitely covered a good set of questions, even including piecemeal payments. It is very important to first understand conceptually all points which we covered in the beginning of the video. If you just know that properly, solving, you will be able to connect it well. Follow the steps, whatever we have discussed. Practice all of the questions which we have addressed today, because each one which was picked is very, very important to practice it before exam. Point down the notes which you feel these are technical or which you feel it is advanced, so that while you're revising, that becomes very helpful for you. So this completes our entire partnership account, guys. A very good weightage when you have to consider this from the exam point of view. Make sure you properly secure this marks, because it is easier, just few points becomes lengthier. If you practice, you will be easily getting through this. Yes, until I come up with the next video, please keep giving your best. You are doing wonderful. Take care of yourself, guys. All the very best.